Now we're going to pivot into the international market, but we wanted to start by looking at LNG because when you start, there's a certain amount of back and forth between middle distillate, obviously heating oil, diesel, and natural gas liquid, and LNG or liquefied natural gas. So when you look at the availability, so as we talked about on the Econ show, Europe ended the winter, or so far, and going to end the winter well above their 10-year average, which is a positive. But now when you start looking at the quote-unquote refill, well, where are they going to source the additional product from? Because they're still getting some piped gas, by no means what they were getting. So that's going to push them into the LNG market. But when you look at Japan and South Korea, they've increased their reliance on Australia because there's less in the market because China has bought up a significant amount of long-term contracts. Now, even after Europe turned off or Russia turned off, whatever you want to say was the first one, piped gas from Russia into Europe, they turned to the LNG market. Now, with China in a steep lockdown, zero COVID policy, there was a reduction in activity. So therefore, there was a reduction in natural gas demand. So depending on the day and the week and month, China was re-exporting or reselling 5.5 to 6% to 10% of their term contract back into the market. And you'll be surprised to know that most of that was going into Europe. So now that China reopens and just normalizes, they don't even have to go get stronger or explode high to the upside. They just have to go back to normal. A lot of that spare capacity goes away, which is going to increase the underlying cost, which is why we talk about the re-rating of commodities higher. People will say to me, Mark, well, look at prices. Prices have normalized. And my comment back is zoom out. We have now gotten comfortable or used to these elevated prices where what we think is quote unquote normal, and don't get me wrong, it's below what it was last year and even the end of the year before. But going back through history, it's still historically very high. And that is the re-rating higher that we keep talking about. It's happening in fertilizer, it's happening in food, it's happening in energy, and it's going to happen in electricity and other places, which is going to be a longer term problem when you look at inflation and why we think you get this stickiness to the upside. Now, before we go into some of the other areas, Iraq is planning to pay for private sector imports. So they're still holding the petrodollar, but they're going to test these private sector imports from China in yuan. And they're looking to inject the foreign currency into the financial system. So there's two sides to this. Is one, they're trying to appease China, but the other is they're running out of dollars and they're trying to preserve those dollars to inject into stabilize their foreign currency because they've seen their own inflation go up. They've seen their exchange rate get worse. And that's going to be a key important thing to watch, especially in the Middle East, because of the importance of the petrodollar and what does that mean going forward. And we should probably do its own show on the petrodollar and the history of it and where it could go from here, because that's definitely something to talk about in its own right. Now, the Russian diesel ban results in a record volume at sea. 24 million barrels of diesel are on the water and rising. Now, this is what we've been talking about in terms of a lot of refined product that's going to compete against this. So if pick your African nation, if you're Brazil, Argentina, do you buy Russian diesel or do you buy some other diesel? And that's where I think you've seen some of these different shifts and why you're going to see a slowdown in U.S. exports. And you're going to see bigger builds in other areas, which is going to put pressure on the middle distillate diesel crack. And that's why when you look at run rates, we went from a very short diesel market, and now we're going into a fairly loose diesel market. And that is going to impact oil demand. And this is the conundrum between an oil glut and a refined product glut. A refined product glut is much harder to nail down because it's mobile, it's fungible. It's oil. Everyone's looking at it, but less people look at the refined product market. And that's where you can get some fairly broad disconnects. And that's where I think you're going to see some of these important shifts. So a record amount of Russian diesel is floating, some 24 million barrels. Then that's the most data based on Kepler going back to 2016. For the first time in at least 7 years, the single most popular destination is, you'll be surprised to know, unknown, which it's funny in its own right. At least 5 tankers laden with diesel-type fuel at Russia's Baltic port are floating off the coastline of Morocco and Tunisia. Kazakhstan applied to Transneft to send 20,000 tons of crude via the Druzhba to German refiners. Still waiting to hear from them. But then the question is, how much of that is it Kazakhstan? Is it Russian? And that's where the fungibility of molecules gets fun. Empty fuel tankers without destination signal the dark fleet. Vessels may be preparing to haul Russian fuel. And clearly you can see that there is no shortage. And that's, again, why we see such problems in the near term, even into the medium term, when you start looking at, and why we keep honing in on middle distillate, gas oil, diesel storage is going to be super important when we're looking at what is happening in the market, what are the margins, and how are refiners going to operate. And that's a key piece. And then when you look at China's diet, no surprise, and I thought this was a really good chart comparing the two with Russia versus Angolan. And that, when we talked about what is being hit as Russia is taking market share from Saudi Arabia, Angola. Now, Venezuela is a mixture because Venezuela is also, Chevron's back in Venezuela. Some of that crude is flowing into the U.S., so there's some fungibility in that, but you can see the clear hit. And Angola is among the hardest hit, with daily exports to China falling 27% so far this month. And that's something that we think is going to continue. But China's apparent oil demand in 2023 may rise 6.2% to 13.74 million barrels a day. And again, whether or not, and this is going to be the different pieces, because as the increase in demand happens, is it going to stay in the country? Is it going to be produced a product? And are they going to execute on their additional export quotas? And that's going to be the piece, because right now there's still a healthy market to export. But that's going to be a key piece, because the forecast change in demand is not in diesel, it's in gasoline. So when you start looking at flows, well, realistically, gasoline, there's a lot of it in the market. So even though China's going to increase demand, they're going to make more gasoline, but there's no export market for it. But yet there's going to be less diesel demand expected based on these estimates from the Beijing-based investment bank CICC. So again, that's why it's hard to get really excited about these oil demand numbers, just because there's going to be a lot of pressure on other refiners, other Asian markets. The EIA woke up and recognized the change in Chinese quarterly oil demand. So we got the pivot higher. Again, we think the EIA is exaggerating a bit. We're closer to where OPEC sits. But again, you're starting to see some of those pivots. But it's also important to see India. So India's nation's, the 23 refiners processed 22.8 million tons in January, the highest since January of 2018, which is about 5.5% year on year. But they also exported a lot. And again, it comes down to they are bringing in more crude, but they're exporting more product. So you're going to see, as that product comes through, well, when you look at Europe, is Europe going to decline or reduce their run rates because they can't get Urals, they can't compete, it's cheaper to buy Indian diesel or gas oil to make their own. And those are the shifts that are going to take time. So you could look at India and say, that's really bullish crude. But then you have to look, it's like, okay, well, if it's really bullish crude, if they're taking in all of this extra oil, making product, and then consuming that product internally. But if they import a barrel and then export a barrel's worth of product, there's a balance, and that's I think what is. I mean, don't get me wrong. It's not. I'm not saying it's like, oh well, clearly everyone's an idiot for not seeing this. That's hard to track. That is not an easy thing to look at because everyone is looking at oil. There's so many metrics on oil, and product is fungible, and that's the sometimes where you can get that lost in translation. We do see some additional downside to crude, but in the near term. Again, range bound. Like right now, you have Brent at 81.97. For those that have been following us, we said 80 to 86 is the range. So realistically, as we got into yesterday, it was coming into a buy moment. And even here, there's probably a buy moment here to watch this go back to 84. And that's going to be that pivot that we continue to highlight. So agencies adjusted a bit. So we had the EIA adjust and then OPEC adjusted as well. So it's just giving you an idea of kind of where some of these views are. But the expectation is for a fairly balanced 2023. And that's a problem if we're going to be balanced because any pivot up or down is going to have some drastic impacts. And on a GDP level, we see that trending to the downside, and we see more product, which is going to hurt oil demand, which was why we think that there's more upside surprises to storage than downside. So Middle East floating storage, we've been calling this out as a big concern, and here you can see a massive move out. And a lot of this is Iraqi crude. A lot of this, we did see some decent discounts from UAE. So a lot of this is just this flow. Iraq did, as we said, they raised OSPs, but nowhere near what Saudi did. So that helped move some of that product, getting things back into normal. Now the question is going to be, as you look at the spot market, are you going to see some additional strength? We already saw Murbain get a bit expensive versus the Dubai benchmark. We saw it get more expensive versus Brent. Murbain did not. So again, you're starting to see this balancing act, and a lot of that is because storage drew down. Some of this is going to come in. A large part of it's going to come into both Europe and the U.S., and then it's where the build's going to come. Is Iraq going to continue on this path, creating some of this lumpiness? And it's really going to be important to look at this, but it's a net positive when you consider the broader physical market. So then when you start looking at crude flows from the U.S., we still are sending a near record into Europe. That's not going to change. We started to send a bit more into Asia, given some of the OSP increases from Saudi. So that still puts us at about 3.8 million barrels a day exports. Now, when you look at Asia gas oil, you can see the pressure in general. But as we've said, it's well below where we were last year, but still high versus 18, 19, 20, 21. So the question is going to be the balancing act between light distillate and middle distillate. And as this gas oil crack comes down and comes under pressure, that's where we see some of those additional run cuts, which is our base case. We do think it gets weaker. We think it's going to struggle as that Russian product struggles to find a home. And then when you look at the the Dubai Brent swap, you can see that Dubai got a little bit more expensive, as we were saying, against that Murbain, which is making that dated Brent look a bit better. Abu Dhabi's front month Murbain futures rose to a premium of more than $4 a barrel versus the Dubai benchmark. So again, you're starting to see some of that movement, which is a positive. When you look at some of those flows, Iraq had some price cuts, Angola had some price cuts, and that helped move some of that product. Global crude oil on the water, a small increase. Again, it's going to be that waffling back and forth, and it's going to be tough because not only are you going to have a lot of crude oil on the water with Russia, you're now going to have a lot of refined product on the water with Russia, and that with Russian product, and that's going to be that balancing act between trying to track all of these different moving pieces. Crude oil in transit bounced. It's going to remain elevated. It's just going to, one of the things that we're going to have to watch out for in March, if you remember, Russia is going to cut their production by 500,000 barrels a day, which is going to reduce exports. So that could help bring some of this down. But just based on miles per ton, distance, it's still going to stay elevated, as floating storage had that nice drop driven by the big drop in Middle East, a steady drop in Asia and Africa. and a steady drop in Asia. Now, we see it flatlining. We don't see a continuous drop, but as we said last week, when things continued down, we thought it was going to bounce back up to 2022 levels. Clearly, we were wrong. We called that out last week as a continuous drop, which is going to put a bit of a floor in the physical market, which is a near-term positive. Asia floating storage, again, you can see here dropping back down, still at the high end, but you can still see this level. The problem is going to be that distance between Russia and Asia. You've seen that drop in Angolan and Middle Eastern crude, the increase in Russian, and that is going to be a timing delay, which is why we had some sizable drops. We should get actually some sizable increases, and it's going to be a bit more lumpy, but still average out to be below where we were in 21 and 2022. China imports on the supertanker side, fairly stable, obviously at the higher end, but we don't see this pivoting up or down all that much, just given where they sit right now, what they have in storage, where pricing is. We see this as being fairly stable. And here you can see that the China congestion index has improved and it's staying fairly strong. We see this rolling over a bit, but still staying above 2019 levels as people try to balance out kind of where things are, the activities people are going to, and how that is going to remain the case. And then as we get towards people catching up, people getting back to a bit back to normal, we'll start to see that level out and come down a bit. And Shandong refinery utilization rates trending higher counter-seasonally, as we've been talking about, still staying at 64.5 million barrels a day. And that's that mixture of cheaper Russian product undercutting the global market, some of that additional demand internally. There's a lot of reasons to stay there, but it's not increasing, it's not creating more shortages in the market. It's just changing how barrels of oil traverse the market and traverse the waterways, and less about actually creating a broader shortfall. West African crude oil and floating storage coming down again. A lot of that was driven based on some recent price cuts, and now that is come back down. We're actually getting some price increases, and again, trying to find this comfort point when you're looking at the physical flows and the physical pricing. Looking at the U.S., gasoline exports were down, distillate was down, and then you could see propylene, LPG was down, but still well above the 5-year, as we have, again, that lumpiness on the crude oil export side. When you look at motor gasoline, as we said, it's going to stay just around the 5-year average. We don't see that adjusting in the near term. When you look at distillate, we fell below the 5-year. We think it's going to hang around the 5-year, but start to edge a bit lower, just given the size of the amount of distillate in the market. And that's going to create some headwinds in terms of flows, and the U.S. trying to compete into what used to be their market, which was Europe, which will remain open. But Latin America and Africa, especially Latin America, was a key export market, and they're starting to absorb that Russian diesel, that Russian product, which will put a damper on our exports, again, driving up some of those storage levels in the U.S. As those storage levels go up, cracks come down, and then you get some of those run cuts. And then obviously crude exports remaining elevated, propane, propylene remaining robust, staying robust. And then ethane exports, trending well above the 5-year. We continue to see that be the case, just because there is that demand in the international world. Now, when you look at Fujairah, for those that have been following us, we said that Fujairah was going to have a big build, and here we are. Fujairah reported 22.4 million barrels in storage, which was a rise of 5.24 million barrels. And it was across the board. Light distillate rose 1.049. And that, again, to 8.2. East of Suez gasoline complex strengthened in early trade, just because amid expectations of Indonesia increasing imports. But the gasoline demand is healthy, but a lot of that is based on Ramadan. As that passes, we don't see it being sustainable, which is why we said there was going to be big builds. We will get a bit of a draw, but again, the net over the next 4 weeks is going to be a net build, and that's going to create some of these headwinds on just this underlying pricing. India imported no gasoline in January after receiving 120,000 metric tons in December. But that's fairly in line. But the country's gasoline exports are expected to be fairly elevated in February and as we go into March, which is going to impact some of that market just based on some of that harsher winter weather. Middle distillate had an increase of 36,000 barrels. Backwardation in the east of Suez gas oil complex widened as there was awaiting some fresh pricing cues. Forecasts show gas oil imports of various grades from east of Suez region are set to rise 34%. And then how much of that is going to be Russian versus other, which is why middle distillate in Fujairah is going to stay low, but start to creep higher as they struggle to compete, and you have some additional refining capacity turning on in the Middle East. Heavy resid rose 4.156 million barrels. Spot trading at the bunkering hubs in Singapore and Fujairah were better than average, but you're starting to see that slow down. You're starting to see, again, some of that additional competition with Russian product. And there's also that continuous issue on the cargo markets, which is why some of that slowdown remains. And this has led to not only a fear that crude may continue to weaken, but also due to an apparent weakening of the upstream cargo markets. And again, some of that is putting some pressure and additional product into storage. Brent time spreads bouncing around. We don't see too much. If anything, we should probably drift a bit higher to the upside. Let's call it between 35 and 40 cents, but not anything back to where we were. When you look at the flows in general, Angolan products slipping out of March into April, as we were discussing, as Nigeria is looking to get closer to about 1.4 million barrels a day in production. Nigeria boosted its OSP of Quibo crude in March to the highest since December. Vital offered Angola's Dahlia at a deeper discount to dated Brent on the Platts window. Nigeria plans to increase loadings of Bongo crude to a 1-year high. Vital offered its crude at minus 75 less dated Brent, and it's essentially clicked down from in 25-cent increments. It was plus 40 cents on February 3rd. It was minus 50 cents on February 21st. Now it's minus 75 cents. Again, trying to find those levels. Nigerian OSPs from March came in $1.27 better than dated Brent, which is above where it was at 95 cents. So again, trying to find these levels, but there's some benefits in that. But Nigeria crude exports production to rise from 1.26 to 1.4 million barrels later this year. And again, trying to find that average, which, if you look at what they're allowed to do, they're still well below quota. So again, they can do that without much issue. Forcados and Amman have delivered most of the improved production. Bonnie Light and Brass could push output up further if outages, sabotage, and theft can be reduced. But again, that's going to be difficult. And you've seen some, as we said, a little bit of firming in some of those Nigerian barrels as Angola continues to compete. Genscape in what's in Europe, as we said last week, we thought there was going to be a bit of a flat line in crude storage. Now we think that there's going to be a steady grind higher. And a lot of that gas oil builds continued, gasoline builds continued. So when you look at gas oil, it's getting now towards the top end of normal. And again, it's still, as a lot of this was ensuring that there was enough coming in, there's some of that backlog from Russian product. But then as that drops off, we should see some headwinds and some pricing in that market. And then when you look at gasoline, seasonally adjusted all-time highs, they're going to have to dump it into the market at some point. And a lot of that is going to end up on the East Coast. And then fuel oil, again, struggling to find buyers with the Russian competition. And that's going to leave a lot in storage and then promote some additional sale runs within or usage within the country. Singapore, you had a small build. You can see fairly comfortable right around where we were last year, but it's obviously the tale of two cities. Light distillate had some draws as countries were pulling stuff in for Ramadan, but you can see even with that pull down, which typically happens usually then over the next 2 weeks, it happened this week. And here you can see we're just back to 2021 levels and below that high that we had in 2019. But you're still at all-time, right near all-time highs, and we don't see it coming down any further. If anything, again, just kind of waffling and setting either new seasonally adjusted highs, even new all-time highs for 2023. But this is going to be a headwind. As we start getting some steadiness in terms of the middle distillate market. In Singapore, we see it staying at the low end of storage, not setting new all-time lows, but again, just staying at the lows. This is going to be important because if this starts to creep higher, which is likely, it's going to pull down that crack spread even further. And again, a lot of this is going to be because of Russian product coming into their market. And then as that Russian resid in the heavy disti was already there, it's there now even more, which is pushing this even further up. North Sea, another flat week in floating storage. Again, typically that happens this time of year. But we should start to see this, pretty much hang around the seasonal average. As Europe had another drop, but it's going to be at that timing because when does it come off of floating storage and go into land storage? When does it get counted? All of that is always a bit fungible. So that's why we think that there's enough backstop to see some steady builds in European storage, oil storage. But again, nothing seasonally abnormal, just very normal at this point in time. That's what we have for you this week. If you have any questions, you can find us in the comment section on YouTube, on the YouTube comment section or on Twitter. And again, we thank you for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.